Hey everyone, me Kevin here. Boy oh boy, we finally got some good news because we have had nothing but bad news lately, which the bad news lately has made it kind of enjoyable to go shopping for stocks at lower valuations, which is part of the good news we're also going to talk about in this video. In fact, if you can believe it, there are two really good news pieces in this video. One has to do with a very important piece of data to the Federal Reserve, and the second has to do with valuations, which we'll talk about both of those. And that doesn't even mention the fact that you still have an opportunity to check out the courses on building your wealth before the price goes up later in the day today, which by the way, somebody asked me, hey, how could a bigger investment into our studio help provide more value to lectures? This was actually a very good and fair question because, like, what does it matter to you if I'm recording on an iPhone or a camera? Well, the answer to that is we are investing in a new piece of visual technology that'll actually be between me and you. It's gonna be really awesome, so stay tuned on that. Okay, so first, we need to understand this. This is really important. This is from Goldman Sachs, and they say something that we already know, but I just want you to see it in writing, that listen to this line here. The jump in long-run inflation expectations last month was, or earlier this month, rather, I thought we're not in July yet, Kevin. Earlier this month was the main reason why the FOMC hiked by 75 basis points in June. And that's true. We saw consumer expectations for inflation rise. And that was on the same day as we got CPI data, which ended up being a problem just a couple days before the Federal Reserve ended up having to hike rates, because the Fed does not want the consumer expectations for inflation to become unanchored. Because if these expectations become unanchored, we're screwed. Then we've got really big problems. Then we go back to the late 70s and early 80s where inflation expectations were unanchored. And what do we get? Well, we end up getting Paul Volckered. So we had a few things in the sentiment release this morning. In the sentiment release this morning, the first thing we saw, which wasn't the greatest, was that consumer sentiment suffered one of its steepest declines in the year ahead outlook for the economy. That means, hey, how do you think the economy is going to do in a year from now? And we saw a 24% decline in that reading, which that's not such a good news part. And you can kind of see that visualized here in the chart, May being the top red box and presently being the lower red box. So people feel like crap, right? And this makes sense. I mean, all you have to do is look at the comments and you see people relatively frustrated about the state of the economy and the state of the bad news that we're getting. But let's get to the right report over here. I've got so many reports up. Let's get to this one over here. This is what I want you to pay attention to. That's not the best news, the sentiment, but this right here is good. First, we know that, and they're reiterating here, that inflation continues to be of paramount concern to consumers. This is important. By some accounts, people talk about inflation now as much as they actually talked about COVID, which is pretty incredible that researchers are even making that kind of comparison, but still kind of neat. But anyway, now listen to this. The final read for June expected that consumers thought that inflation in the year ahead would be 5.3%. That's actually back down from that higher level where we thought inflation expectations for the year out were going to rise. This has been pulled back down to 5.3. That's good. We were seeing this re-anchor. And longer run expectations had a reading of 3.3% at the middle of the month, and they've settled back at 3.1%, which is that good range that we've been in for literally the last 10 months, 2.9 to 3.1%. So think about that for a moment. For the last 10 months, despite all of this inflation insanity, consumers' longer run inflation expectations, like 5 years out, 3 to 5 years out, are anchored in the 2.9 to 3.1% range. Now that's still above the Fed's target of 2%, but it's way better than these numbers becoming unanchored, and it's good that we saw both of these numbers come down, especially after, as we saw Goldman say, the last sentiment read was probably why we saw the Fed raise rates by 75 basis points. In fact, you see it here. Since the preliminary reading, the Fed hiked by 75 basis points. They're even mentioning it. And that was higher than the 50 basis points they telegraphed. Now, a downside potential risk for this going forward, and this was really weird. I had never thought about this one before, but look at this one here. A key upside risk, so an upside risk to consumer sentiment, is actually a barrage of political advertisements highlighting high inflation ahead of the midterm elections. And they say that inflation expectations have historically been quite sensitive to political outcomes. However, we don't actually have a lot of data of elections and political advertisements and people's inflation sentiment, because we generally in the last 40 years have had pretty low inflation. But if inflation is a core issue going into the midterm elections, what happens if all of a sudden all we get are a barrage of inflation style ads? Everybody's complaining about inflation, especially Republicans who have much higher inflation expectations than Democrats. Take a look at this. You can kind of see you got Republicans over here with the expectation that inflation in a year is going to be around 7%, where Democrats see inflation as only around 3.9% in a year, and then independents right here in the middle. So you could see there's an element of Democrats thinking inflation is transitory and Republicans thinking we're screwed, right? And an election cycle with everyone talking about inflation could actually lead people to have more salient present information about how bad inflation really is and how to fight it. And it could actually make people feel less faith in the political process to actually solve inflation, as they should, because Congress doesn't get anything done anyway. Neither does our administration, really, at this point. But anyway, no, I'm going to get political here. Anyway, point is, inflation expectations could actually turn ugly towards the election cycle, and Goldman Sachs believes that the Fed might feel compelled to respond forcibly to those increases in expectations, which might just be temporarily fueled by election ads. How crazy is that? Like, I would have never considered that, oh yeah, political ads are all of a sudden going to screw our inflation expectations, but it kind of makes sense. It's pretty wild. Anyway, folks, remember, now we've got something else important to talk about as well, that's valuations. But remember, folks, yes, the coupon down below. No, okay, remember, I think these are all opportunities to buy. And so I'm a big fan of buying when there's pain and stress. I'm not a big fan of margin, though, right now. Stay away from that. So I do want to take a look at this, though. I wanted to show you this. Look at the forward PE ratios. Just as this is the S&P 500, the large cap index, and take a look what we've got over here. This is where we sit right now, and that's a PE ratio of about 15.8, a forward PE of 15.8. You can see that's still above some of the lows that we saw during the pandemic lows in the end of 18. If you go over to mid cap at 11.3, we're actually kind of in line with what we saw during the pandemic and what we saw, well, 2008 was still lower. But look at small caps over here, folks. Small caps, they seem to have hit a historic bottom in small cap PEs measured by, the S&P 600 is your small cap, S&P 400 is your mid cap, and 500 is your large cap. But anyway, for the best potential deal, it seems like the S&P 600 is an interesting potential play, maybe for even like an upside hedge or something like that. So I thought that was fascinating, and we'll be talking about that a lot in the course member live stream later today, so I look forward to that. Now, if you need a ticker symbol for that, the S&P 600 can be traded with VIOO. That's your Vanguard, and VIOO, let's see how it's done year to date. Let's see, VIOO stock, year to date, down 18.44%, which actually I think that's less than the SPY is down. Yeah, SPY's down 18.93%, so really interesting. But anyway, VIOO, that's, valuations have gotten quite depressed there. It's up about 5% from bottom right now, but still nominal given that you're down 18.4% on the year. Anyway, just a trade idea. Thank you so much for watching, folks. Check out the program's link down below with that expiring coupon code, and folks, we'll see you in the next one. Thank you. Bye.